Welcome viewers to a journey of financial discovery unlike any other. Have you ever wondered the reasons behind why certain individuals achieve financial freedom and wealth, while others do not? Do you know how many years it will take to double, triple, or quadruple your money at a given interest rate? Or what your investment strategy should be for retirement? How much you'll receive? Have you thought about what rules you should follow when purchasing a car? Or whether you should buy or rent your home? Have you ever dreamed of unlocking the secrets to financial freedom? Do you know the magic rules that financially independent people follow? Because those financially independent and wealthy individuals understand the psychology of money and are familiar with basic money-making principles, while others don't. If you find yourself in the latter category, let's explore what those principles are. Well, get ready to embark on an epic quest as we unveil the 17 magic rules of money and investing. Whether you're a seasoned investor, passionate about getting rich, or a curious rookie, this journey will be your ticket to mastering the art of wealth creation and financial independence. These thumb rules are more than just guidelines. They're the compass guiding us through the turbulent seas of financial uncertainty. Imagine this, a roadmap filled with golden nuggets of wisdom, guiding you through the twists and turns of the financial landscape. From setting achievable goals to making informed investment decisions, these thumb rules are your treasure map to a brighter financial future. But wait, there's more. Each rule is a beacon of light, illuminating the path toward financial freedom. So, grab your compass, sharpen your wit, and join us on the road to financial freedom, as we uncover the golden rules that will change the way you think about money and investing forever. Are you ready to level up your financial future? Let's dive in and discover the secrets of financial mastery, one golden rule at a time. And hey, don't forget to hit that subscribe button below to join our growing community of money-savvy adventurers. Trust me, you won't want to miss out on the treasures we're about to uncover. Let's start. Number 1, Rule of 72, Money Double Rule. This rule estimates the number of years it takes for an investment to double at a fixed annual growth rate. For example, suppose you have an investment with an annual growth rate of 8%. Using the rule of 72, divide 72 by the growth rate of 8, and you find that it would take approximately 9 years for your investment to double. Number 2, Rule of 70, Money Half Rule. This rule estimates how long it will take for your purchasing power to erode due to inflation. You divide 70 by the current inflation rate to determine the number of years it will take for your purchasing power to halve. For example, let's say the current inflation rate is 3%. To estimate how long it will take for your purchasing power to halve, you divide 70 by 3, which equals approximately 23.33 years. So, at a 3% inflation rate, it would take around 23.33 years for your purchasing power to decrease by half. Number 3, Rule of 114, Money Triple Rule. This rule estimates how long it will take for your money to triple when compounded at a certain interest rate. You divide 114 by the interest rate to determine the number of years it will take for your money to triple. For example, suppose you're investing in a fund with a compounding interest rate of 8% annually. To estimate how long it will take for your money to triple, you divide 114 by 8, which equals approximately 14.25 years. Therefore, at an 8% compounding interest rate, it would take around 14.25 years for your initial investment to triple. Number 4, Rule of 144, Money Quadruple Rule. This rule estimates how long it will take for your money to quadruple when compounded at a certain interest rate. You divide 144 by the interest rate to determine the number of years it will take for your money to quadruple. For example, let's say you're investing in a savings account with an annual compounding interest rate of 6%. To estimate how long it will take for your money to quadruple, you divide 144 by 6, which equals 24 years. Therefore, at a 6% compounding interest rate, it would take approximately 24 years for your initial investment to quadruple. Number 5, Diversification Rule. This rule in investing serves as a general principle for asset allocation. This guideline suggests that, on average, stocks yield around 10% annually, bonds yield approximately 5%, and cash yields about 3%. Over the long term, investors might anticipate an average annual return of 10% from stocks, 5% from bonds, and 3% from cash. Furthermore, the 10-5-3 rule offers a framework for diversifying investment portfolios. It recommends allocating around 10% to high-risk, high-reward investments, 5% to medium-risk investments, and 3% to low-risk investments. Number 6. The 3-6 rule, emergency fund rule. This rule suggests having an emergency fund that covers 3 to 6 months' worth of living expenses. For example, if your monthly living expenses amount to $3,000, your emergency fund should ideally have between $9,000 to $18,000. Number 8. To 100 - age rule. Similar to the 110 rule, this rule guides the allocation of stocks in your portfolio based on your age. For example, if you're 30 years old, you would allocate 70%, 100 - 30, of your portfolio to stocks and the remaining 30% to bonds or other fixed income assets. Number 9. 10% investment rule, minimum investment rule. This rule encourages saving and investing at least 10% of your income towards long-term financial goals. For example, if your monthly income is $5,000, aim to invest at least $500 per month towards investments. Number 10. Retirement saving rule. This rule provides a rough estimate of how much you should have saved for retirement based on your age and income. For example, if you're 40 years old and earn $60,000 annually, you should aim to have saved $240,000 for retirement. You can find multiplying your income of $60,000 by your age of 40 divided by 10. Number 11. To 4% withdrawal rule. This rule suggests withdrawing 4% of your retirement savings annually to ensure it lasts throughout your retirement years. For example, if you have $1 million saved for retirement, you would withdraw $40,000 annually, savings of $1 million multiplied by 4%. Number 12. The rule of 20, stock market valuation rule. This rule evaluates whether the stock market is overvalued or undervalued by comparing the price to earnings (P/E) ratio to the nominal GDP growth rate. For example, if the P/E ratio is 20 and the nominal GDP growth rate is 4%, the market is considered fairly valued. 20 minus 4 equals to 16. Number 13. The rule of 15, real estate investing rule. Rent or buy. Used in real estate investing, this rule estimates the maximum price to pay for a rental property based on the annual rental income. For example, if a rental property generates $15,000 annually in rental income, the maximum purchase price would be $225,000, rental income of $15,000 multiplied by 15. Number 14. The rule of 15-15-15, rule of investing. This rule suggests that you should invest 15% of your income for 15 years in a mutual fund that offers 15% annual returns. This rule aims to encourage disciplined investing over a long period to achieve substantial growth in investment returns in terms of compounding. For example, suppose you invest 15% of your annual income into a mutual fund that offers a consistent annual return of 15%. Let's say your annual income is $50,000. So, after 15 years of investing $7,500 annually according to this rule, the amount in the mutual fund could potentially grow to approximately $96,045.75. Number 15. The personal budgeting rule. A budgeting rule that allocates 50% of income to needs, 30% to wants, and 20% to savings and debt repayment. For example, if your monthly income is $5,000, you would spend $2,500 on needs, $1,500 on wants, and save $1,000. Number 16. The rule of 25, early retirement rule. This rule is associated with financial independence and early retirement, suggesting that you can retire once you've saved 25 times your annual expenses. For example, if your annual expenses are $40,000, you'll need $1 million saved for retirement, which you will get by multiplying your $40,000 earnings with 25. Lastly, number 17. Car purchasing rule. When purchasing a car, this rule advises making a 20% down payment, financing for no more than 4 years, and ensuring monthly payments, including insurance, don't exceed 10% of gross income. For example, if your annual income is $60,000, your car payment, including insurance, shouldn't exceed $500 per month. You will get $500 if you multiply $60,000 by 10% divided by 12 months. And there you have it, folks. A treasure trove of financial wisdom to guide you on your money-making journey. From doubling investments to planning for retirement and mastering the art of budgeting, these thumb rules are your trusty companions on the road to financial freedom. If you found this video helpful, don't forget to hit that like button, drop a comment with your thoughts, and subscribe for more financial gems to supercharge your wealth journey. Remember, the goal isn't just more money, it's living life on your own terms, which you truly deserve. Until next time, happy investing.